This is Grok Trade 101, Part 3, Technical Analysis. Real quick, our educational disclaimer. These are for educational purposes only. We are here to teach and educate you to be a better trader and not to give you financial advice. If you seek financial advice for your securities, that needs to come from a professional financial advisor, and we strongly encourage that. Let me introduce you to one of our mentors, Mark the Meerkat, also your host for these 101 courses. He's a mentor, a trader, an analyst, and a host to the Grokstar Trading chat room here at Grok Trade. He trades actively for a living and he does it daily, so you are in good hands. With no further ado, let's turn it over to your host, Mark the Meerkat.
Hey, thanks, Keisha. Hey, let's get started here. Lesson number 3, Technical Analysis Basics. In this lesson, we're going to talk about technical analysis, price action, volume, indicators and oscillators, as well as market internals. So let's get going. What is technical analysis? Why should we even do it? Well, there's a lot of people out there who say, oh, you just need to do fundamental analysis only. And there's some out there that say you do technical analysis only. Well, here at Grok Trade, we want you to learn a bit of both and balance them. What is technical analysis? Well, this is the charts. It is looking at the charts in a real disciplined view of the price action and the volume, as well as indicators and oscillators that we put on there to kind of give us visual interpretations of what's going on with the price action. Main components that we're going to talk about here with technical analysis is, first of all, price action. Then we're talking about volume, different support and resistance levels, trend lines, indicators, oscillators, and the broad market internal indicators. Now, with technical analysis, some tips about this is trading is based on probabilities. But when we incorporate technical analysis, it really increases our probabilities of getting in at the right time, managing our trades, and getting out at the right time. Again, about increasing our probabilities. Technical analysis also needs to be balanced with that fundamental analysis, as I mentioned earlier. You need to have both, because fundamental analysis tells us which stocks we need to be trading. Technical analysis tells us exactly when and to the penny where to enter. We want to master technical analysis for our trade entry, for our trade management, and for exits. That's why we use technical analysis. Now let's talk about price. Price is king. That's right, ladies and gentlemen. It is king. What is price? It is simply what the present value is given by the market for a security. Now, what is price action then? Well, price action then is a study of the historical price levels, one beside the other, as it takes a path on the chart. It's kind of what we call a footprint of human emotion. Because when the price is going up, more people believe that the price is going to go up, so they buy it and keep paying higher prices. But then when more people believe it's going down, their emotions change. Well, that's when you see a swing on the chart or a pivot to where it starts going down, because now more people believe it's going down. It's about human emotion. The most common types of charts that we use, first of all, is the line chart. Now, it only tracks between different closes, from one close to the other. Now, throughout this video here, I'm going to be talking about each candle is going to have the value of 1 day. It's going to be the duration of 1 day. For the line chart, it's going to connect the close of each day in that case. The other one is what we call a Western bar chart. And a Western bar chart shows you the high, the low, the opening, and the close, all in one little stick. But there's a little nub on the left-hand side, that's where it opened. There's a little nub on the right-hand side, that's where it closed. And then it shows the high and the low as the length of that particular stick. But the one that we like to use is what we call Japanese candlesticks. That also shows the high, low, open, and close of each day. But these candles visually give you more information. Let's talk about these candlesticks for a minute. If the close is higher than the open, then we have a up day, or the price went up for that particular day. Now this candle will then be represented in what we call the body, the center square. That's going to be either white or we say empty, unfilled. That would show you that it is a bullish day. Then it shows the high and the low, or the little lines that stick out from there we call the wicks. Now, if the close is lower than the opening, then it was a down day for the market, a bearish day. for that day, and it's going to turn out to be red or sometimes filled with black. So you have white and black, or you might have green and red, up versus down. Now it's also going to show the high and the low. So it depends on whether the close is higher or lower than the opening as to what color that candle is going to be. But visually, it gives you, when you put them all together here, begins to give you a nice picture. You can very quickly tell if that day was a bullish day or bearish day as compared to those bar charts. It's just a stick. You have to really look closely to tell if it was a bullish or bearish day. So it's a sequence of events then to begin to set up different chart patterns for us that we can now begin to see when the odds are going to be in our favor. It's going to go in a particular direction. We have what we call support levels. Kind of think like this is a floor in a building, and you jump on it, and you can't go through, and you jump on it again, and you don't go through, and the third time you go through, and it doesn't go through. So there's a particular level of price that this particular stock just does not want to go below. It's kind of a significant level. Now, it could be because of it's an even dollar amount, or it could be it's its all-time low, or whatever the reason. People don't want to sell it for 1 penny less than that area. Then another one is the resistance. Now think of this as the ceiling or the roof. You jump up, you hit your head on it, and then come back, you try it again, and then you try it a third time. There's a resistance there. You can't go any higher. Well, that happens with stocks and its pricing. It could be a specific level that no one is willing to pay any more than that. And so every time it gets to that area, it pulls back again. These are areas of support and resistance. Now, diagonally, it could happen as well. Those little, what we call pivots, where it changed direction from going up and then coming down, that's a pivot high. Or if it drops down and starts to go back up again, that's a pivot low. We also call them swings. When you get these swing lows, you can connect them here, as in this line here in this example, and you connect it 2 or more. Now you have what we call a trend line, and every time it comes back to that area, it seems to reverse. And again, it's only odds in our favor because it's going to keep doing it until it doesn't. We become educated in Japanese candles, and we're going to have a lesson actually on candlestick reversal patterns as well as trend reversal patterns in later lessons. But you need to study these different chart patterns as well in our free chart school. Go to freeonlinetradeeducation.com, and it's a free chart school there, and it has all of those patterns indicated there, a page on each one. And then enroll to the more advanced mentorship, because that's where you're going to learn how to use them. Now let's talk about volume. Volume is queen. What is volume? It's a number of shares or contracts traded in a security during a specific time period. So again, if each one of these candles up above is 1 day, the blue bar down below represents how many shares were traded in that day on that stock. Volume plots the actual number of shares traded between buyers and sellers. Now, it's not the number of orders filled. Don't make that mistake. There could be one order for 10 million shares, or it could be 10,000 orders for 100 shares. It's the total volume. Now, individual volume of any specific trade that you make is going to be included in that volume. And for that particular candle, whatever time frame you're looking at, so if you're looking at a 1-minute candle, you'll be included in that one. But then it's going to be added to, on the 5-minute candle, it's going to take the volume from the 5 1-minute candles to the 5-minute candle. And the daily candle is going to take all the trades from that day and be added into the one candle. So nothing gets left out. They're all plotted in one of the time frames, and cumulatively, the bigger the time frame, they're all included in there for volume. Now, how are we going to use volume? Well, one way we use it is for liquidity, to make sure we can get into a trade at a reasonable level and get out at a reasonable level. If you have illiquid stocks where it's, there's hardly any trades in a day, it's very difficult to get in a we're going to be able to determine to the penny when the odds are in our favor to get into a trade. And if you can't get in because the spread on it is 3%, well, that's not going to be acceptable. Now, in the really heavily traded stocks, the Apples of the world and all that, well, the bid and ask spreads are very narrow, usually a penny or two, and it's very easy to get in and out very close to your projected area. Now, if you don't learn anything else in all 6 of these lessons, this is the one thing you need to learn. You need to write this down, write it many times, say it out loud, and tape it right to the side of your monitor. Volume confirms price action. I'll say it again. Volume confirms price action. It's that important. You have to look at the value because it gives you like the worth of what that price bar is. So should I pay attention to this particular price action bar or not? Volume will confirm the price action. So let's do a little pop quiz here. You see this chart, this is running up, and then we have these white candles, they run up there, but look at the volume there, it's really, really tiny. But look at the last 3 bars. The pop quiz here is, do you think this is just a gentle pullback, or do you think this is a reversal? I say it's a reversal. Why? Because the volume on the 3 candles coming back is enormous compared to those when it ran up. That's how we use volume to measure the worth of a particular candle. Next we have indicators and oscillators. And yes, there's a difference. We'll talk about that in a moment. What is an indicator and oscillator? It's actually a formula. Now this is the formula for the MACD. We've talked about that earlier in one of the lessons. Go ahead and pause the video and memorize this. I'm just kidding. No, you don't need to memorize the formula. You just need to know how to use that particular indicator, and if it adds value to your trading, you keep it. Now, these are formulas that are usually based on price and volume, all these different indicators. There are hundreds of indicators and oscillators out there, folks. Now, indicators, what are they versus an oscillator? An indicator, they are not plotted in a specific range. They can be anywhere on the chart or within the plotted area of an understudy. So some examples of that would be moving averages or Bollinger Bands. They follow the price action. It can be anywhere on the chart. An average true range is another example. That just adds up the range of the last 14 candles in this case here. And it's saying that this particular stock, the range of it each day is about 1.62. That can go anywhere depending on what the price of it is. That's an indicator. An oscillator, on the other hand, is plotted in a specific range. So that's where it gets its name oscillator. It oscillates in a range. Now, there's 2 types. There's a center oscillator, like the MACD. Now, it oscillates back and forth around a center line, which is a 0 line for the MACD. Another type is a banded oscillator, and stochastics is a banded oscillator. It oscillates back and forth between 0 and 100. It can't go beyond that, can't go below that. It's going to be somewhere in that range, and you use that to help you confirm what you're seeing in price action and volume. That's oscillators. So indicators and oscillator tips, you can use our chart school. We have a whole section just on indicators and oscillators, and there are hundreds of them. You need to pick out 2 or 3 and master them. Choose those that you can actually test and quantify to see if it adds to your trading or does not help. If it doesn't help, take it away. If it adds to your trading, keep it. But you don't get too many of them, just like I showed you in an earlier lesson. When we put 100 of them on there, they're never going to line up so you can actually trade. And the indicators are generally not leading, and this is an important thing to remember. Because they're based on formulas, it takes data from history, it takes a while to recalculate it or to show up as a change in the indicator or the oscillator. Price action and volume are right now live time, so you get instant data there, while the other ones are slightly lagging, some more than others. Now let's talk about market internals, and these are indicators and oscillators that we use for the broad market or to see what's happening on the inside of the market. Now, the broad market indicators incorporate various points of data to measure what the sentiment is. So we can tell, is the market bullish, bearish, or is it in neutral, to give us a direction. Now, here's just a few that we watch. The tick, which is the net of all New York Stock Exchange upticks and downticks, and that's an instantaneous one. The trend, which is a ratio of ratio. The net volume, the advancers and decliners. We have bank, and we have VIX, which is also known as the fear factor, which is the call-put ratio. So these are some of them. I just want to introduce this topic to you today because there's a lot more to it and how to use that. Now, if you watch our daily video on the broad markets, we use several of these in that to help us analyze what's going on, not just the broad market indexes, but what's going on internally in the market. Now, if you are a day trader, it's an absolute must that you have some internal indicators to use and rely on to help you in your trading. So pick 4 or 5 of them and master them, and then learn how to use them when you're in the 301 mentoring course, and because it's vital, especially for day traders. Well, what have we learned? We talked about technical analysis, price action, volume, indicators, oscillators, and market internals. Now, for you to become a savvy trader, you know what you need, right? You need to become adequately educated. You need to have the knowledge, the essential knowledge of what it takes to be a good trader. But the other thing you're going to need is, once you have the knowledge, you're going to need someone to help you along the way as you begin to implement it for your trading. That's where a training mentor comes in. Remember, 89% of people out there do not make money in the markets. But of the 11% who do, I venture to say 90% of them have a mentor. What are you going to do? We think the next step for you could be to enroll in a Meet the Mentor program. Go to groktrade.com, and you can sign up for a Meet the Mentor program. It's just a brief webinar to answer your questions about what is this thing called mentoring and what could it provide for me, and then you can make a decision as to what the next step might be for you. Now, our next lesson here, boy, we've been covering a lot. We talked about foundations, infrastructure. Now we just talked about technical analysis basics. Next is charting. That's right. Take a look at the charts and some patterns that happen on there. Wow, it's been fun. This is the Meerkat. Learn to trade well.